If I look back over the 14 years, in the initial days of the pandemic, I think that was comparable uncertainty to what we have now. It was also an amalgamation of a shock impacting upon demand and supply, where you had to come to an assessment, oh my God, what is the time profile of these shocks? What will dominate in the short run? What will dominate in the medium term? Because that's the relevant policy term for us. So more or less, it feels a little bit like, March 2020.
So what kind of data are you looking at then? The incoming data, is it soft, hard data? What kind of data do you want to see before you make your next move? Obviously you made a move last week, but I see some of the consensus. There had been some discussions around the edges. This is what Mr. Holtzman told me this morning. What data are you looking for?
Well, this shock has the potential to have a differential impact in the short run than in the medium to long run. So in the short run, it's crystal clear that the uncertainty that is created by the unpredictability of the tariff actions by the US government, that uncertainty that works as a strong negative factor for growth. It's basically, uncertainty is like a tax without revenue. So in the short run, we will have lower growth. We will probably also have lower inflation, as we also see the euro is appreciating, as energy prices have also come down. So together with the sort of negative factor uncertainty, in the short run it's crystal clear that it will accelerate the disinflation that will. But in the medium term, the inflation outlook is not all that clear. I think there are still these negative factors, but in the medium term you might get retaliation, you might get the disruption of global value change, which might also be inflationary in other parts of the world than the US only. And then of course we have the fiscal policy coming on in Europe. So this is actually a time in which you need projections. Projections where you can see the time profile of the impact on both growth and inflation. And I'm looking forward for our June meeting to see the projections.
Would that be a good time to wait it out and see what happens?
No, I'm fully open-minded. I think it's way too early to already take a position on June, whether it would be a hold or another cut. It will fully depend on these projections, on how the medium-term outlook for inflation will be affected by these opposing factors. On the one hand, weaker demand, but on the other hand, possibly retaliation, fiscal policy coming on, etc.
The market is currently pricing in roughly 2 cuts this year by the ECB. Are you on board with that pricing? Does it sound okay to you?
I don't feel actually in any position to comment on market pricing yet, so it's too early to say whether I'm on board or whether I would not be on board. There is just too much uncertainty yet. I would need to see a more structured analysis of the impact on the inflation profile ahead of us. And only then can I say whether the market is pricing fair or whether I don't. I would disagree.
One thing is clear, we have seen a strengthening of the euro against the US dollar. We're at a 3-year high, and that is on the one hand because the euro and the euro area is now seen as a safe haven. There's a loss of trust in the US dollar. Energy prices have come down. We're expecting cheap imports from Asia. That gives you some leeway, some breathing room in terms of further cuts. Is there an implicit bias here because you've got that breathing room?
No, I don't think that there is an implicit bias at all. Again, we have opposing factors on the medium-term outlook for inflation. We will have to await the data coming in order to inform us whether this will actually be inflationary over the medium term or whether this will be deflationary. I think we're in a pretty good place actually with rates at this moment, because rates are neither restrictive nor stimulative. I think that's a good place to be in. And once there's more clarity on how this will impact medium-term inflation, then of course we can contemplate what to do with rates.
Mm-hmm. One of your colleagues said it might be worth lowering the rate to below neutral. What do you think?
Well, to me that would be a little bit premature yet, because that would be a deliberate decision to say, okay, we need stimulus. We need to provide stimulus to the economy. I would not be there yet, because for me, the uncertainty around the medium-term inflation outlook, it's really a two-sided risk. It's not in the short run, it's a one-sided risk. I fully agree with that. But our mandate is on the medium term, and on the medium term the risks are much more evenly balanced.
Mm-hmm. Can I come back to the strong euro? Can I ask you whether it hurts European competitiveness at this point, at the levels that we're at? And secondly, does the Eurozone need to get used to the euro being a safe haven and all its implications for monetary policy and prices?
Well, we will just analyze the strong euro as one of the factors going into the projection and one of the factors going into the inflation outlook. Obviously, it makes euro area prices outside the euro area a bit higher. So yes, it has an impact on competitiveness. At the same time, if I look at the level of, for instance, the euro-dollar exchange rate, that has not been uncommon in the somewhat longer history of the euro.
Can I ask you, looking back on your legacy as you're stepping down from the Governing Council soon, can you sort of summarize what you think your legacy has been and how the ECB has evolved?
Well, it's of course not my legacy. It's probably, then you have to talk about the ECB's legacy. Now, over the 14 years, I think we've had unprecedented shocks. So we had shocks where the textbooks that we all learned economics from when we were at university didn't provide an answer for. I think we have, for each shock, ultimately we have found a solution. We have come up with new instruments, we have been quite innovative, etc. And throughout that period, we by and large have been able to deliver on our mandate. So that should be, I think, the leading legacy in my view.
Do we need new tools now?
Well, we can't exclude it. I think our toolbox is much richer now than it was 14 years ago. So the likelihood that we can actually use an existing tool for any future problem is now much higher. But you know, if we have to be innovative, we can be innovative.
Does that include bond buying for defense purposes?
Well, I mean, bond buying we would only do if there is a sort of disorderly market movement, or if we were again to arrive in a situation where we would have a structural low inflation trap that we couldn't get out of. I think that the sort of dissimilarities of this period relative to the 2010s are such that I don't think that we will arrive at such an effective lower bound episode anytime soon. So I don't think that that is very relevant in the current context.
Can I ask you, as you're the chair of the FSB, are you concerned about financial stability and what you've seen in the markets over the last month or so? There is this big concern that something will break, something will crack. Have you seen anything that keeps you up at night?
No, actually what we have seen so far is that markets have continued to function. So margin calls were actually met. Yeah, there was volatility, but volatility was absorbed. Now, over the last 4 years within the FSB, we've of course worked very hard with a program to strengthen resilience in what we call the non-bank sector. It would be too early to already sort of claim victory here, because most of the standards that we issued still have to be implemented. But it may well be that the continued attention that we had for weaknesses in the NBFI space have actually led to a somewhat higher risk awareness in the sector already, so that this time around the sector was better prepared than, for instance, it was when we had the March 2020 dash forecast, the Archegos, the UK LDI episode, etc.